Good morning and a warm welcome. In fact, a very warm welcome, as it's expected to reach 28 degrees in London today. So turn up your heat pumps, sit back and relax for 1 hour of avoiding capital allowances blunders. We've had around 250 people register for this event, and we're just waiting for a few last-minute stragglers. Rachel from Accounts, yes, thank you. You can see you've just logged on. And so has Nadine at Avoiding Taxes. But Ed at Green Energy, he sends his apologies. Sadly, he's got connection problems this morning. His solar panels have overheated and his wind turbines are stationary. Never mind, Ed, I'll send you notes on green allowances. And in fact, if any of you listening would like a CPD certificate, let us know, email us after the event, and we will send one through to you. Firstly, I'd like to apologise to anyone who is offended by this webinar graphic. We did get a couple of complaints. People said, how could we caption Rachel from Accounts with two unscrupulous characters? The key point, though, is we're not here to talk about the politics. The point we're trying to make is how, by listening to this event, you can avoid serious capital allowances blunders. And I think it's probably fair to say that a lot of people think Trump has blundered with his tariffs, clearly Putin with Ukraine, and Rachel has come under criticism for some of her tax policies. But the key point is this morning how we can avoid making blunders in a capital allowances context. And of course, politics, economics, and taxation are very closely linked. And if we look at the educational background of the chancellors of the 21st century in the UK, 75% of them have a background in politics, philosophy, and economics. The exceptions are Kwasi, who studied classics, and you'll remember he only lasted 38 days, and Nadine, who studied chemistry, he stretched it out to 63 days, while negotiating a 5 million personal tax settlement with HMRC. That's probably one of the quickest settlements in HMRC's history. The rest of us would still be waiting to get through HMRC's phone system in 63 days. If only perhaps Nadim and Kwasi had studied PPE, they may have performed better than a short life asset. Well, if that was the reason, step forward Liz Truss, who did study PPE and only lasted as Prime Minister for 49 days. Well, now we can get into the serious business of capital allowances. Robert Jenrick, thank you. He's just emailed to say his office is up and running. In fact, he's been running for office for a long time, and he did the marathon this weekend in 4 hours and 40 minutes. Please do post questions during the presentation. It will make it a lot more interesting. And the observant ones of you in the audience will have noticed this champagne bottle. This will be sent to the person who posts the most interesting and helpful question during this presentation. And if following the presentation you have any questions, please do feel free to contact me or members of my team. And let's have a look at the recent spring statement that Rachel Reeves delivered quite recently towards the end of March. Was there anything significant in this area? Well, it was pretty modest in the context of capital allowances. They kind of reiterated some relatively old news that there is going to be consultation around the 150% land remediation tax relief. They are also considering whether they will extend the 100% allowances to leased assets. So for instance, if you're a construction company and you buy a crane in your construction business, if it's for your own use, you can claim 100% full expensing, so all the allowances in 1 year. But if you lease that to a connected company or a third party, you would just get normal writing down allowances at 18%. HMRC have indicated a few times, or the Treasury have, that they will give a little bit more clarity on what expenditure qualifies for allowances. They keep saying that and they haven't yet delivered. And they have said they will give, again, some clarity around pre-development costs, particularly in the context of energy projects, wind farms and the like. And they have published further guidance on the phasing out of furnished holiday lets. So nothing too radical. It's broadly a continuation of the last government, Jeremy Hunt and Rishi Sunak whilst he was Chancellor. So no radical changes in this particular area. My guess would be, for the life of this Parliament, I would not expect radical change in capital allowances. In other news, it was announced this week that the Valuation Office is going to be part of HMRC. Capital allowances kind of sits between HMRC at the moment and the Valuation Office. So let's suppose you buy a commercial property as a second-hand asset, there is a capital allowances valuation required. Most tax inspectors currently will refer that to capital allowances specialists within the Valuation Office if they have a concern. In practice, we've seen very few queries from the Valuation Office over the last few years. So my guess is, what does this mean in practice? I would say people who do capital allowance at the VOA and business rates specialists, capital gains tax valuers, they will probably, instead of reporting to the VOA, they'll probably move into a HMRC office and maybe report to more senior tax inspectors. So in the short term, I wouldn't expect too much of a change. The other bit of news is, I think, again this week, the Gunfleet Sands case, which relates to offshore wind farms, that has gone through the courts. It started with the tax tribunals, and then it went to High Court, Court of Appeal, and my understanding is it's on its way to the Supreme Court. This seems very odd to me, that this is kind of expenditure that Miliband has been trying to promote, and the direction of travel in most countries, wind farms and the like. And yet they're making it very hard. And I think this was an overseas company originally, or it was better, it was set up overseas originally. It's a UK company that incurred the expenditure, filed the capital allowances claim. They've made it really hard for them to claim allowances on some of the fees and associated pre-development costs. Not a great advert for investing in the UK. There's never been in dispute that the turbines themselves are plant machinery. It is associated costs that are being challenged. And I think it's fair to say that we are in an environment where there are pressures on the UK economy, as there are on most economies currently, and it's likely that taxation will increase. And this is a chart of the tax receipts made by HMRC going back to 2005. And what is quite fascinating, that the total tax that is collected by HMRC is broadly exactly in line with increases in retail price indices, with the exception of the COVID years and maybe a couple of cases, 2008, when there was the financial crisis. But over time, tax receipts broadly increase in line with RPI. It will be fascinating over 25, 6, 7, whether that statistic will be maintained once the economy comes under more pressure. But it has been reported today by Barclays and I think Morgan Stanley and other banks, other economic predictors. They are predicting some good news for the property industry and other businesses and individuals, that they are expecting 3 or 4 base rates this year and next year. I think there's consensus clearly can be wrong, but the prediction is that there will be lower base rates in the UK, which may well help the economy. And most of these taxes tend to come from personal taxes like income tax. Clearly NIC is likely to increase, but the 3 big ones are income tax, NIC, VAT. And corporation tax has been steadily increasing. 5 or 6 years back in time, it was around 50 billion. It's now exceeding 100 billion. So those are the main taxes. And then if we look at spending, spending cake is increasing. This is an extract from the government's red book, or the unread book if you're an MP. But as well as taxes going up, then spending is also generally increasing, and 9-10% is very significant. And the UK national debt as a percentage of GDP has also been rising. Now, the UK national debt is something like 2.8 trillion, which is a huge amount. But if you think that's a big number, then have a look at the US national debt. This is an extract from a US debt clock, which yesterday showed it at close to 37 trillion. So why am I giving this overview? Well, it's basically the background is in most economies, we've got high public spending and we consequently need high taxation to pay towards that spending, along with high debt levels. So I think it's fair to say that corporation tax, income taxes are unlikely to be reducing, certainly in the UK, anytime soon. Rachel Reeves indicated that she will keep corporation tax at 25% for the life of this Parliament. She's also publicly stated that she will maintain full expensing. That's the 100% allowances for general pool plants. And she has quite helpfully said capital allowances will be no less generous than they currently are. So hopefully she will stick with those assurances. And just to put capital allowances in context, I've used some relatively big numbers here because they're easy to understand. Capital allowances apply not just to big numbers, but they apply to individuals as well, and they work equally well with smaller numbers. And one of the things that property people sometimes don't understand is they think, well, if we buy a building or we spend money on a building, we get depreciation in the accounts. So we get tax relief through accounts depreciation. In the UK, that's simply not true. One of the first things you do when you're doing a tax calculation is to add back any accounts depreciation to increase the taxable profits. So in the UK, the starting position is zero tax relief on accounts depreciation. In other jurisdictions, it's slightly different, and I'll talk about that later. You are able to deduct bank interest, albeit for the last few years it's been capped at a maximum of 2 million in most cases. So you can, if this is a propco, or it could be, say, a hotel business, you are able to offset bank interest and any associated allowable expenses. So in this example, okay, it's fictional, you would be then able to reduce the taxable profit down to 1.6 million. And the benefit is the following line, that if you have capital allowances, if you've got enough capital allowances, you may be able to reduce that down to 0, or whatever the figure is for the legitimate amount of capital allowances in that year. And the other great feature of capital allowances, they are uncapped. So bank interest, yes, there's a 2 million cap. There is no cap on the quantum of allowances currently in the UK. So if someone spent £1 billion, they may be able to claim £1 billion worth of allowances. And that is a very legitimate way to reduce taxation, whether you are a company, an individual, or an LLP. We see as a firm a whole variety of capital allowances advice, and some of it is good, some is bad, and some is downright ugly. And where we see good capital allowances, it's based on the legislation, it's based on case law, and they've looked, or their advisors have looked at not just current expenditure, but they've reviewed opportunities in the last 5 or 6 years, or even further. So there are time limits for claiming capital allowances in a particular tax year, but if you miss those time limits, you can still claim in later periods. So if you bought something 10, 20 years ago and you didn't claim allowances and you can prove that you didn't, then you may be able to make an additional claim in a current or open tax return. The bad situations we see are people have not properly claimed, they've underclaimed, maybe they've just had some invoices from a builder which are not detailed, and they've just dumped it all into ineligible, and as a result they've missed claiming allowances. And the ugly is there's mistakes in tax returns. We do see those more often than you'd expect. Occasionally you see wrong advice, double claiming of allowances, see people sometimes forgetting to file capital allowances elections. And I would say the more common bad example is people not properly disclosing, not disclosing the basis of the capital allowances claims. So try to avoid those blunders. And just to go into this, clearly here is the headmistress of Blunders, Liz Truss. These are some of the key points. I mean, there are other ones as well, but just I was racking my brain yesterday. And a common mistake is if you're buying a building, just automatically accepting a tax election from the former owner and just claiming that figure. So it is quite common for somebody selling a building to put in a tax election of £1. Now, a lot of people will just assume that is the legitimate figure, and that is the only figure they will claim. And it's worth asking more questions. I had a case a couple of months ago where exactly that scenario, a £1 tax election was documented by both the seller and the buyer, and that was the figure that pretty much everyone assumed would be due for the allowances. However, when we asked questions, we found that the seller had never traded from that property. They owned it in an SPV, and then immediately after selling the property, they'd gone into administration. So they had no entitlement to claim allowances because they never traded. And so that election, we were able to tear it up. Another thing we see commonly is capital contributions towards tenant plans. So in the last few years, landlords have found it harder generally to attract tenants. They've been giving more in the way of rent freeze, and as a result, they've also, in some cases, been giving capital contributions towards tenant fit-out works. And there is a mechanism in the Capital Allowances Act, in the legislation, to claim capital allowances if you're the person giving on plant and machinery. And probably only in about 50% of cases are those contributions documented for capital allowances purposes. So ideally, if you're a landlord, you want to allocate them to plant and machinery, and most probably to the capital allowances at the fastest rate, such as full expensing, to the extent that is applicable. Also, generally speaking, a lot of people will lump those capital contributions into a Section 198 tax election. That's not technically correct. Technically, they should sit in a separate pool, and the tax written down value would normally transfer across to the next purchaser. We also see people spending a lot of time negotiating a quantum of elections, and then they don't actually include them in the tax return. That is a problem. They need to be sent to HMRC within 2 years of completion. We see a lot of cases where people have had poor details from their builders, contractors, professional team, and the building costs not nicely segregated, and they just ignore it. And they don't, as a result, claim the allowances for which they are entitled. I did say once to a tax advisor, there are too many tax nothings. And they said, what are tax nothings? Well, that surprised me. I said, well, it's the stuff that you get no tax relief on. So it is always worth reviewing the tax nothing and the nothings in a computation to see anything may be reallocated. And some people have claimed a lot of allowances, and again, they forget to agree a tax election when they sell. Some 10 years or so ago, there were a lot of changes in this area back in 2014. And we offered some free CPD to a few law firms. Some said yes, they'd like it. Some said no, they'd already covered it, it's fair enough. But there was one firm that stood out, and they said, there is nothing that you could tell us that we don't already know. Now, interestingly, a few months after, that very same law firm acted for one of their clients who had claimed allowances, and they didn't put a Section 198 election in the sale contract, and their client got full clawback of the allowances. So I think there were a few things that perhaps they could have learnt. And one, again, a quite common mistake is in the tax computations, you have this thing called the annual investment allowance, and the first million of any type of plant and machinery, you can take it out of a slow plant allowance out of, say, 6% and move it across into 100% tax relief. And there are quite a few, probably junior accountants, junior tax advisors, who forget to apply the annual allowance to the slowest plant, and instead they apply it to faster plant. So essentially the speed of the tax relief in someone's return is slower than it needs to be. Another mistake as well is Section 198 tax elections. They only apply to fixed plant. So movables, so if you're selling a hotel, selling a nursing home, movables should not go in a tax election. They can be treated separately, and there may be a capital allowances benefit as well as an SDLT benefit. So those are some of the common ones. There's Donald blowing us all some affection. That's not really an image I'd like to stare at for too long. Clearly, I would say if the expenditure is complicated, the records are poor, then it is worth appointing genuine capital allowances specialists. I've talked about before about not fully disclosing. Another common mistake is there can be in an SPV a very favourable interaction with the plant and machinery allowances and the capital gains. So if you have excess capital allowances in an SPV and you sell the asset out of the SPV and you fix the capital allowances for say £1 or a low figure, any plant and machinery allowances which have not had tax relief, so they're basically sitting in the pool, you can then offset them against the capital gain, provided the SPV is liquidated after the sale. The other thing we sometimes see is poor relations with HMRC, not disclosing. I mean, look, HMRC are just doing their job at the end of the day, so treat them respectfully. And, you know, I'm not averse to asking tax inspectors their opinions, or within HMRC, they have a capital allowances policy team. They are full of, well, I wouldn't say full, but they have smart people in those teams. Ask their opinion, disclosing your capital allowances claims. And for very large cases, we do sometimes interact at an early stage with a tax customer relations person, senior person within HMRC, who will engage with large corporate taxpayers. The other thing we see very often missed is expenditure which goes through service charges. So if you, for instance, buy a property and the previous owner put a lot of plant machinery through the service charge, so for instance they replaced the lifts and they were able to put it through the service charge, then there won't have been capital allowances, there wouldn't have been any entitlement to claim capital allowances by the former owner because it was on revenue account. But when the next person buys that property, they are buying capital expenditure. So there can be an opportunity to look at expenditure that's gone through service charges where there is a change of ownership. There are a few questions. I will deal with these. The tax receipts, they were in billions, and we will be sharing the notes with you. We had another question. Is it only the person who makes the capital expenditure that can claim? For example, a tenant undertakes works, can the freeholder claim? You have different rights to capital allowances, and that is a good question. I don't know who you are, Nick, but I think that's a really good question. You are going to win this Perrier Jouet champagne. It's a really good question. I'm really glad you've asked that question. So capital allowances do go with expenditure and with a land interest. So let's take an example. Let's supposing I'm freeholder of this building that we're sat in, which incidentally is the case. Now, if I, as the freeholder, do some work to maybe, it's very hot today, I decide to put a wind turbine on the roof. Now, if I, let's supposing I spend 50k putting a wind turbine on the roof, then I have a land interest being a freehold, and I've incurred expenditure, it's capital expenditure, and it's on plant and machinery. So I, as the freeholder, can claim capital allowances I'm sorry, I hope you can all see. I got a message to say the camera is, there's a problem with the camera, but hopefully you're still all able to see me. If you can see me, can someone just post a message in the chat just to let me know the camera's all working fine? Fine, great, thanks for the confirmation there, don't know what happened. So I was explaining as freeholder, if I stick something on the roof and I've got a land interest, I've incurred capital expenditure, I have an entitlement to claim capital allowances, provided I capitalise it and don't put it through the service charge. However, at the same time, one of my tenants in the building who's got, say, a 3-5 year lease, they may decide to put some of their own cooling equipment on their floor. Well, again, they have a land interest being a short lease, and they are also incurring capital expenditure on plant and machinery. They also will have entitlement to capital allowances. And there was another question. Whereas Section 198 capital allowances election has been filed, but the seller did not have a right to claim capital allowances, is it okay to ignore the 198 and proceed with a claim? Then yes, if so for instance, you might have a situation where a property developer puts in a tax election. I have seen that. It's not capital expenditure, and then you get an assurance, or you see from maybe Companies House, their accounts, which states that it is trading stock and it's not capital expenditure, then that tax election would not be valid and you could tear it up. I would recommend that you disclose it in the capital allowances claim that you're making for the buyer so that HMRC are aware of the facts. Furnished holiday lets, I'll talk about briefly. The legislation is being phased out from 5th of April this year, and generally there's a lot of people out there, normally individuals, who tend to own furnished holiday lets, some through companies. Up until 5th of April this year, they've had entitlement in most cases, if they meet various tests, that they can claim plant and machinery within the holiday let, and also in the garden if, say, there's a swimming pool, which some in fact do. Now, there's a real benefit going forwards that if those capital allowances losses are crystallised before the change, then they can be carried forwards pretty much indefinitely. And the other real benefit is those furnished holiday let allowances can be offset against other rental profits in the same ownership. Whereas in the past, FHL losses were ring-fenced against the profits of that trade. There was a NASI in the budget. Inheritance tax is not my area, so I'm not going to talk about it too much. But I would say anyone who's bought a property within a pension fund, that was a favourable tax structure before April this year. But for anyone that's going forwards, I would say that you might want to think very carefully before you buy a commercial property in a SIP, because you could be leaving behind an IHT problem for your beneficiaries. I think if you get effectively, your beneficiaries get taxed twice if you're over 75 at the time when you pass away. So it's probably more effective, and take tax advice on this, it's not my area, but if there are, you may be better just buying it in a limited company and claiming capital allowances, which will also help shelter rental profits, but take advice on that point. There will be situations where there are no capital allowances. So in my case studies, I'm obviously going to be talking about situations where there's a lot of allowances, but there will be some cases where there literally are no additional allowances, and that will be where the seller has claimed everything they legitimately can. They put in a £1 tax election. They've not spent any extra money that they've not got around to claiming allowances on. They haven't made, say, capital contributions to tenants, and there's no big spend in the service charge. So there will be some situations where there are genuinely no extra allowances. Green allowances, there's my good friend Ed Miliband. Before he became a recent minister, I used to cycle past him, normally around the embankment. So he was, I guess, eco-friendly in terms of cycling in those days. And I'm pleased to advise, according to ChatGPT, he has a heat pump at home. It took his house apparently from an EPC D rating to an EPC C, not an A rating. That's not good enough, Ed. But more seriously, what can you claim capital allowances on in terms of green plants? Well, we do a fair amount of work on waste to energy plants, solar panels, solar farms, seeing quite a bit of expenditure on batteries, normally on a concrete plinth in farmers' fields, wind farms onshore, offshore. What are the key capital allowances issues? Well, sadly, there's been no special tax incentives in the UK for quite a long period of time. This green tech all falls within normal capital allowances rules. The one key thing I would say that you have to really take care of is to consider whether they are fixtures or chattels, movables. So the capital allowances legislation is more stringent relating to fixtures than it is to movables. If they are fixtures, then you need to have a land interest of some type, and I think HMRC's guidance is there needs to be some kind of exclusive land interest or exclusive license to occupy. That can be quite tricky with some of this technology. And if you sell one of these, then if you've treated it as a movable and it is a movable, then you will get a full clawback of the capital allowances up to the price you're selling it for. Whereas if you've treated it as a fixture, and probably most of these are fixtures, then you can use the tax election mechanism. So if you spent 10 million on it, you could technically dispose of it for £1 and keep the 10 million of allowances. So those are some of the key features in terms of capital allowances, but sadly, unless maybe Ed is able to persuade Rachel, there are no special capital allowances advantages, it's just normal rules. Quick recap here, what kind of stuff do we get 100% allowances on? It's typically things which depreciate a little bit faster, so CCTV, kitchen carpets, demountable partitions, subject to a few conditions. The key test to get 100% allowances, it has to have been incurred by companies. So if you're an individual or you're a partnership and you're not a corporate partnership, or if it's second-hand assets, then you won't be able to get 100% allowances via full expensing. You may be able to via the 1 million annual investment allowance because, for instance, it doesn't have to be new. The annual investment allowance applies to individuals, it also applies to companies and partnerships. So you do have to be a little bit careful claiming the 100% allowance via full expensing. Half expensing in the first year, you get 50% tax relief, and then in subsequent years, 6% on a reducing balance basis. And as I keep mentioning, you can accelerate it out of the 50% or the 6% into 100% using the AIA. The UK generally is quite positive in terms of capital allowances, and we do work in other jurisdictions, have some knowledge of them. Sometimes we partner with other local specialists. But generally speaking, the real advantage of the UK is you can keep the tax relief on sale of an asset, whereas in pretty much every other jurisdiction in the world, the benefits of allowances are clawed back on sale of an asset. The other positive in the UK is, as I mentioned, the capital gains tax interaction within an SPV. And the allowances now in the UK are very much accelerated as a combination of the AIA and full expensing. So compared with other jurisdictions, particularly I would say if you're constructing something for the first time or redeveloping something or fitting out a space, you'll get tax relief on pretty much most of that expenditure if it's commercial expenditure. It's less generous in respect of second-hand assets. It will depend on what capital allowances have or not been claimed and the tax status of the seller. Why are allowances important? Well, hopefully you've already figured that they are by now. I mean, if capital allowance is done properly, it's not a scheme, it's not something that's artificial. Pretty much all governments have encouraged individuals and corporates to get a tax incentive when they invest in the UK economy, and we certainly need investment right now. So, generally speaking, HMRC operates a light touch regime, particularly if the allowances are fully disclosed. As I mentioned, there's no cap on the quantum of allowances. You can fix the allowances when you sell. So we have a very flexible arrangement in the UK. And these allowances are valuable in the context of personal tax rates of 45% and corporate rates of 25%. So it's legitimate. They are still underclaimed in a lot of cases, and they are intended to help investment. They are still most probably underclaimed. UHY, the accounting firm, did a Freedom of Information request, and they estimated, government came back and estimated about 12 billion of corporation tax was overpaid in 2022. My guess is a good chunk of that relates to underclaimed capital allowances. And that's me outside number 11 Downing Street with Larry, the very well-fed cat. Mr. Starmer, he promised his children an Alsatian dog, apparently, but they ended up with a Siberian kitten that cost £2,000. I doubt he's claimed capital allowances on that. And despite the cat being from Siberia, they rejected the name Vladimir. And also, as it wasn't a free gift, they decided not to call it Lord Ali. They settled on the name Prince. Larry came from Battersea Cats and Dogs Home. He was trained by David Cameron to attack rodents. He's seen off 6 prime ministers so far. These are the kind of assets that fall in the 50% pool. I'm not going to go into great detail here, other than mentioning that the definition changed in April 2008. And this is an example of a fit out or a refurbishment of by a tenant. And again, I'm going to skip over the calculations here, but other than the key points that on projects below around $1 million, 2 million, you should be able to get very fast tax relief through the combination of the annual investment allowance, full expensing, if there is any land decontamination like asbestos removal, repairs, and then the rest of it on the slow structures and buildings allowance. This is a case study here, someone buying a building from City of London Corporation. You might be thinking, well, why is John being so specific here? I'm using them as an example because they do not pay corporation tax. Effectively, their buildings have charitable status. So if you are buying this building from them, the purchase contract would probably be silent. There would be no segregation of allowances. And my guess would be a lot of buyers, unless they have capital allowances specialists, would therefore not claim any allowances. However, in this scenario, the legislation, if there have been no claims made by a previous owner, you can effectively, under 562 Capital Allowances Act, apportion the price you paid and attribute value to the allowances. And on a building like this, there could be allowances of 20–30% of the price paid. Who can benefit from allowances? I think we've covered these in the questions, so I'm going to skip over, other than commenting. Most allowances relate to commercial property. You can claim allowances in some cases on residential, such as furnished holiday lets, communal areas to student accommodation, and communal areas to residential blocks. And here's a little crib sheet for in your notes. So pension funds, charities, they can't claim. So if you're buying from one of those types of companies, entities rather, then you would normally expect to get a reasonable amount of allowances. You might be thinking, this all sounds very simple. I've got good property lawyers, I've got good accountants. So, why do we need specialists? Well, the reason is the construction process does not always facilitate those, your good advisors being able to segregate expenditure. And it's quite common in construction just to see invoices that say building works with no detail behind them. And the same when you buy a property, the allowances are often not segregated. And if you don't believe me, this was an extract from a company that we looked at where no allowances have been claimed on the purchase of buildings and nothing on the building works, other than a couple of invoices which were for things like furniture, computers, and those have been claimed because it was absolutely obvious on the invoices. We quite often give upfront early advice before people buy buildings, and we try to forensically piece the information, the history from brochures sometimes have information, selling agents sometimes no, and your clients will put together or will receive standard inquiries which the lawyers ask each other, so there's about 10 questions or so about capital allowances. And on this particular example, the seller said there were no allowances. Then they said you can have the tax return down, which was a low figure, just 100,000. And we did a little bit of research, and we found that the previous owner had held it for 2008, which meant they couldn't have claimed certain allowances due to a change in the law in April 2008. And so we were able to get extra allowances on the purchase and also another set on the redevelopment expenditure. Residential properties, I've covered that. You can get tax relief on repairs. There is no residential restriction for claiming repairs allowances. So if you have a buy-to-let property, for instance, and you replace things, you replace the windows, kitchens, whatever, then you can still get tax relief on that as a repair. It needs to be broadly like for like rather than radical improvement. These are the standard CPSEs. Most lawyers tend to use the same practical law version. Some have slight variations. And there's a whole series of questions. How do you hold the property? The reason for that is to try to see if it's a non-taxpayer. Have you claimed? They're quite detailed, and capital allowances specialists can help with those answers. Sometimes the responses are gibberish. The most interesting one I saw, the whole section was had the words confidential, which was super helpful. And one of the most useful questions, I'm struggling to find it, is please give contact details for your capital allowances advisor. That can be super helpful. If the responses seem odd, then it's worth picking up the phone or emailing their advisor. There are time limits, as I mentioned, for claiming allowances in a particular year end, but if you miss those, you can claim in an open or current period, provided the property or the expenditure is still used. My favourite allowance is land remediation. I like it because it's 150% tax relief, and I think it's good for the environment, removing hazardous substances like asbestos, removing oil in the ground. Well, what's not to like about someone that is doing that kind of expenditure, maybe building something on brownfield land? There are quite a few restrictions. It's reasonably complicated allowance, which is probably why it's not very often claimed. You can't claim it if you're an individual. You used to not be able to claim it if you're offshore, but now you can, because offshore companies fall within corporation tax. It's really worth looking for this particular type of allowance. And property developers, unusually in this context, they can benefit from this tax relief. There are investment zones in the UK. The key point I would say about them is they're a lot less generous than the kind of Margaret Thatcher period enterprise zones. They're not geared at individuals. Tax benefits are very much targeted at owner-occupiers. Trade of leasing is denied, so propcos can't benefit. Be a little bit careful with propco-opco structures. So you'll only get the benefits if you own the property in a trading business that's actually carrying out a trade, but it is something to consider. The citing of property, we've had quite a bit of success with, say, manufacturing type companies. The least claimed allowance is probably capital research and development allowance. Most people, there's a whole industry of R&D advisors. They tend to focus on P&L expenditure rather than fixed asset spend. So it is worth considering if a company is genuinely carrying out R&D and they've incurred capital expenditure. Doesn't apply to propcos, but it does apply to trading businesses. And I would say if you want to have an efficient capital allowances process, consider your capital allowances early on. Have some wording in the offer letter, a bit more detailed but not very detailed in the heads of terms, and very detailed in the purchase contract. Essentially, who's going to do what and when. And if you want to see an example of capital allowances going badly wrong, Google the Glade House case. And you will get most capital allowances when previous owners have not been entitled to allowances. That's what I've termed the golden scenario. Or a more typical scenario is you go outside when it's raining, like Rishi did, and you get very wet, and the seller has claimed some allowances, but maybe there's an opportunity to claim more. The opportunity here is former owner owned it before the magic April 2008 date, so could not have claimed integral features for things like general power, cold water and solar shading. And just to check you've been listening, here's a case study of these three best friends. And let's supposing you are advising Mr. Zelensky, who's the only one here, a bit like myself, not wearing a tie today. You have to do the forensic details. Can Mr. Zelensky claim any allowances? Well, you probably find out that Donald, he's claimed 20 million. He's probably put in a £1 tax election, probably only time in his life he's got something out of Putin. That would mean that Putin has most probably claimed nothing. Does that mean Zelensky also gets nothing? Well, again, we can do the April 2008 scenario. So Putin could potentially have claimed allowances extra over and above Donald's 20. Putin probably didn't like all of Donald's gold everywhere, so he's probably carried out some works. So there may also be some expenditure that Zelensky can claim. Could have been some expenditure gone through the service charge. And I would say those, and there could have been some capital contributions made by Putin. Could be some movables in there. So there are lots of opportunities potentially, particularly on a property of this value, that Zelensky should consider to see, or his advisors consider to see if they can get more allowances. I did more than 30 years ago, I should confess, do some work for Donald Trump, not as Lovell Consulting, did some capital allowances work in the US on one of his casinos. I would say it's a good time to do capital allowances forensic work, especially when there's fewer transactions. People have got a bit more time, a bit more energy to dig out details on things from the past. And I've done a little matrix here of the situations where you can get allowances. So ideally, you want to be in a scenario where there's high capital allowances and a high purchase price. That's going to be things like energy projects, hotels, offices, where the sellers are non-taxpayers, or maybe where the seller made a big capital allowances loss. We've got a case at the moment where one of our clients bought a building for a big amount, they spent a large amount on it, is now only worth a tiny fraction of what they themselves spent on it. They're looking to sell that at a big loss. I think they're going to sell it for something like 10 million. There will be a capital allowances election for 10 million worth of plant machinery. Now that is very unusual, but it does sometimes happen. And where you're going to have low allowances is things like low, if you're paying 100,000 for an industrial shed, then the capital allowances are going to be quite modest. This, if any of you recognise, is Cardinal Pietro Parolin, who, according to the betting markets, is the favourite to be the next pope. If you want to place a bet, there are no betting shops within Vatican City. There is, though, in the Vatican a supermarket, and surprisingly, it sells duty-free wine. In fact, Vatican City has a high per capita alcohol consumption. 105 bottles of wine are consumed per person per year, which is something like 3 times as much as the UK. It's a great time, as I keep saying, to do capital allowances housekeeping. I won't make my standard joke about my wife being my housekeeper and keeping the house, but there are a lot of tax savings to be available, often by reviewing previous capital allowances claims. I'm going to leave you with a few notes on how to get good levels of allowances and hopefully avoid the negatives around capital allowances, so avoiding the blunders. I'll also leave you with a summary of the capital allowances cases. If you Google any of these, you'll find good commentary. A key thing I would say is if you want to avoid cases, then fully disclose, engage positively with HMRC. In my capital allowances career, which is over 30 years now, I've never had to take a case through the courts. They've all been resolved amicably. And these are some of the common misconceptions. People quite often think it's too late to claim, not often the true. They sometimes think they'll pay more capital gains tax, which again is not normally true, particularly the only time there's an interaction is if you sell for a loss. And a lot of people think, well, my lawyers, my tax advisors, they deal with this. Clearly, your tax advisor, your lawyers understand the legislation, they probably understand it better than we do, but we have the practical experience day to day and the ability to segregate expenditure and to deal with the practicalities of where information is imperfect. This is where we're based. There's a queue of people waiting for details of our next webinar, and I have concluded the points I'd like to make. There are a few questions, so I will rattle through those and try and answer them as best I can. Right, so I had a question, does an interest include a licence over land for CA purposes? There is some guidance on this for HMRC. This was a key point when PFI was vogue. So you'll remember back in the Gordon Brown period, there was a big expansion of private finance initiative. The interest in land points was challenged at that time by HMRC, who did give guidance. And in simple terms, you need to have an exclusive license that gives you right of access to maintain, service that plant machinery. If you Google it, I'm sure you will find more details. Will a recording be available? Yes, that goes to anyone who's not a direct competitor. Can you provide some brief comments on allowances for student accommodation, as allowances appear limited? That is a good question. So with student accommodation, it's changed over the years, and HMRC themselves have changed their opinion a few times. And sadly, no one has been brave enough to take a capital allowances case through the courts. Now, in the legislation, there is a restriction for claiming capital allowances in a dwelling house. And HMRC's interpretation is that that dwelling house restriction applies from the front door of a student bedroom, but for the stuff which is in the communal area, like the lifts, the heating, lighting, dining areas, lounge areas, you should be able to claim capital allowances for the communal areas. So if you Google HMRC student accommodation capital allowances, you will find the HMR view. However, I think it's unfair because in a hotel, they say you've got to trade as a hotel, even if you've got a proper co-opco structure. In a hotel, they don't take that point. They accept that you can claim capital allowances throughout a hotel. So you are absolutely correct that compared with a hotel, allowances on student accommodation are more limited. You can, if you've got nasty stuff in the ground, claim the decontamination allowances as well. And I think this is our final question. Why are 150% allowances limited to companies? I think the reason is they didn't want people like Wayne Rooney and David Beckham being able to invest in partnership structures where they could shelter income at 150%. So I think that is the only reason. It's the most generous allowance in the context of capital allowances, and they wanted to incentivise companies, and they didn't want wealthy individuals benefiting. I think we are done now with the questions, unless there's any others. Thank you. Well, I've tried to stick to time, so I've had to rattle through some of the older slides. But if anyone has further questions, by all means, please do contact, and we will try and track down the lucky champagne winner and get that across to you in the next few days. Thank you all for listening.